Hi, this is Jessica Dunn, and we're going to look at some Chapter 3 practice problems today. So for this practice set, you're giving some financial statements. Here's the income statement, and then you're also given the balance sheet, as you can see here. Um, Within this, it gives you some historical numbers, so it tells us some ratios for 2023 and 2024. It wants us to calculate the ratios for 2025, and it gives us the industry averages for 2025, so we can make some comparisons and some judgments on this company, or we can point out questions that we may have with and be more informed about those. So let's just jump right in. Let's calculate the financial ratios for 2025. First up is the current ratio. And remember, current ratio is current assets divided by current liabilities. So if we go back and we look at the balance sheet, we see that total current assets are $1,531,181. And current liabilities are $616,000. So 1,531,181 divided by 616,000. That gets us 2.49%. So current ratio is 2.49. So we can see from that our current ratio has been increasing, and it's well above the industry average. So just off the cuff, we should be doing well liquidity-wise. We should have enough assets to cover our liabilities, enough short-term assets, enough cash and cash-like assets to cover our obligations as they come due. Because remember that current assets are those assets that you expect to convert to cash within 1 year, and current liabilities are those bills you expect to pay within 1 year. So we are in a very good shape to cover those. Our current ratio is quite high. A quick ratio is a more conservative measure of liquidity. So it's the same as the current ratio, except you subtract inventory from your current assets, and we then divide by current liabilities. So the reason for this is that if a company is struggling financially, it's often because they can't sell their products. So warehouses full of products that won't move are invaluable. They have no value. And so we should discount that from our current assets to see if there's still enough cash and cash-like assets to cover our bills as they come due. So looking at this, we already know our current assets. We talked about that. But in 2025, our inventory is $700,625. So we need to deduct that from our current assets and then divide by current liabilities. So the 1,531,181 of current assets minus our inventory of 700,625 divided by 616,000. And that gets us 1.35. So even looking at just the quick ratio, I mean, again, rule of thumb is greater than 1 is good. Greater than 1 means that you have more than enough cash and assets that are being converted to cash within 1 year to cover those bills that you expect to incur that year. So this company should have no problem meeting their bills as they come due. One may even argue that we don't know what industry. Well, we know it's a manufacturing company, but we don't know what their future plans are or really what type of manufacturing they're in. Is it heavy manufacturing or light manufacturing? We don't know if it's custom or stamped out material. So we don't really know a whole lot about this company, but one could even argue that they have too much current assets. They have, because their current ratio is so large compared to the industry, and their quick ratio is about the same. We could potentially argue that maybe they're holding too much inventory. But we don't know. Maybe they got a large discount for purchasing a bulk order, or maybe it's just that time of the cycle where they are taking shipment of large pieces, preparing for future production. But there is always the argument that a current ratio can be too high. I wouldn't really say that with this company. If the current ratio were 4 or 5, I would say absolutely they have way too many current assets. They should be either dispersing those assets or using them in a more productive manner. But I think this company is doing well. Their current ratio of 2.49 is higher than the industry average, but when we deduct inventory, their quick ratio is pretty close to on par with the industry. So next it asks us to look at inventory turnover. Times inventory turnover is equal to cost of goods sold divided by inventory. So we need to go back to our financial statements. Cost of goods sold is on the income statement, $3,704,000. And we divide that by inventory, which is on the balance sheet. That's $700,625 that we already looked at. So with this one, we had $3,704,000 divided by $700,625. So that gets us 5.29. So their inventory is turning over 5.29 times per year. And I say per year because when we look at these balance sheets and income statements, they are for the year. So if this had been quarterly, it would have been 5.29 times that quarter. But these are yearly, so they're annual statements. And so we know that it's turned over 5.29 times. It's been pretty static over time. So from 2023 to 2025, their inventory turnover has remained pretty stable. But compared to the industry average, it's substantially lower. And we'll talk more about that in just a moment. Average collection period looks at how long it takes to actually receive those sales made on credit. So how long does it take us to receive our accounts receivable? So this is calculated as accounts receivable divided by average sales per day. Accounts receivable divided by average sales per day. So we first need to look at our accounts receivable. 805,556. And then we also need to know our sales. Our sales was $5,075,000. Now we do divide that by 365 because again this is annual statements. We're looking at a year here, so we have to divide by 365. So that's 805,556 divided by our average sales per day. That's 5,075,000 divided by 365. And I get 57.9 days. So we can see that it's taking this company longer and longer to collect. So in 2023, it took 50 days to collect. In 2025, it's taking us almost 58. And the industry average is 46. So it's taking us much longer to collect. Is this just an immediate negative, this is a failure company? No, we don't know. It just leads us to more questions. Question 1 would be, have you recently changed your accounts receivable terms? Are you giving people 60 days to pay instead of 45? Did you change that? Because then that would see an obvious uptick in days receivable. Another question would be, are you sending out notices and bills in a timely manner? Have you changed your credit practices? Are you extending credit to more individuals? Or have you increased lines of credit to already existing customers? And maybe now they can't afford that higher limit. It doesn't immediately condemn the company that their average collection period is increasing, but it does give us questions to ask management. Total asset turnover is next, and total asset turnover is calculated as sales divided by total assets. Sales divided by assets. So our sales is found on the income statement, $5,075,000, and assets is found on the balance sheet, and for that we have $3.125 million. So our sales of $5,075,000 divided by $3.125 million. That gives us a total asset turnover of 1.62. So we see that total asset turnover was 1.5 from 2023 to 2024, and now it's 1.62, still below the industry average of 2. What does this mean? Maybe they're not as operationally efficient as their competitors, but it does look they're increasing, but not substantially. So maybe they're not using their assets as efficiently as they could. Debt ratio is calculated as liabilities over assets, so total liabilities over total assets. Both of these are found on the balance sheet. Our assets are $3.125 million, and our liabilities is $1,781,250. So total liabilities was $1,781,250. Divide that by the $3.125 million, and we get 57%. So our debt ratio has been climbing significantly year over year. In 2023, it was 46%. In 2024, it was 54%, and now it's 57%, which is substantially above the industry average of 24.5%. So they're borrowing more and more money. They're very highly leveraged. So they may be seeing some financial trouble. Okay, times interest earned. Times interest earned is earnings before interest and tax divided by interest. Earnings before interest and tax is also called operating profits. So two words. Two words, same meaning. Operating profits and earnings before interest and tax can be used interchangeably. But it's $153,000. We divide that by our interest expense, and our interest expense is $93,000, right below that. So our earnings before interest and tax divided by interest is $153,000 divided by $93,000. So that gets us 1.65. So we see that over time, our ability to pay the interest on our debt has declined, which goes hand in hand with an increasing amount of debt. So we've increased our debt, and so we haven't been able to, or we're not as able to comfortably make that obligation. So our times interest earned ratio has declined from 2.2 in 2023 to 1.65 in 2025, with the average being 2.5. So again, maybe a sign of some financial difficulties. Gross profit margin is a measure of profitability. It's calculated as sales minus cost of goods sold divided by sales. So if we look at our income statement, we see that sales is $5,075,000 and cost of goods sold is $3,704,000. So $5,075,000 minus $3 million. I boogered that up, haven't I? Minus $3 million. $704,000 divided by $5,075,000. And with that, we have a gross profit margin of 27%. So our profitability has been pretty similar. 27.5 in 2023, increased a little bit in 2024, and is now 27, and pretty similar to the industry average. So let's move on to net profit margin. Net profit margin is earnings available to our common shareholders divided by sales. So earnings available to our common shareholders divided by sales. Earnings available for common shareholders is $33,000, and sales is $5,075,000. So that's 0.65%. So our net profit margin has declined dramatically from 1.1% to 0.65% in 2025, with the industry average being 1.2%. So we're looking at half of the profitability of our competitors. So that's not painting a very pretty picture for our company. Remember, net profit margin is the final measure of profitability, so it's looking at all expenses at the end of the day, including those very high debt payments. So you notice here that our debt has increased dramatically year over year. And so that's likely one of the largest culprits for this. Return on assets is equal to earnings available to common shareholders divided by assets. So earnings available to shareholders over assets. So we already know our earnings available to common shareholders is $33,000. We just looked at that in the last one. And now we can look at total assets, which is $3.125 million. So $3,125,000. And so I got 1.1%. So our ROA has decreased dramatically from 1.7% to 1.1%, and is much lower than the industry average of 2.4%. So we're not using those assets efficiently. Borrowing that money probably was not the wisest choice. It didn't spend it well. They didn't spend it on quality assets that were going to generate a return. Return on common equity. This is earnings available to common shareholders divided by common stock equity. Now we first have to calculate common stock equity. Common stock equity is equal to total shareholder equity minus preferred stock. So if we look, we see total shareholders equity is $1,343,750,000. So $1,343,750. And preferred stock is $50,000. So we do have to deduct that to get common stock equity. So common stock equity is equal to the $1,343,750 minus $50,000. So that total shareholder equity minus preferred stock. And so we get $1,293,750. So we can plug that in. So we have our earnings available to common shareholders, which was $33,000, divided by that common stock equity of $1,293,750. and we get 2.6%. 2.6%. So our return on common equity has declined as well from 3.1 to 2.6, and is below the industry average. Price earnings ratio. This is the market price per share divided by earnings per share. Market price divided by earnings per share. Okay, so market price is actually a footnote on the balance sheet, and it says that the stock price is $11.38 per share. And earnings per share is given to you on the income statement of 33 cents. So that is $11.38 divided by 33 cents. And that gives us a price earnings ratio of 34.49. Remember, this is how much investors are willing to pay for every dollar in sales. It has fluctuated a little bit over time, gone up and then down in 2025, and is substantially lower than the industry average of 43.4. So that means that investors don't have a very optimistic outlook for this company as compared to the industry, because they're willing to pay less for every current dollar in earnings. Market to book ratio. This is the market price per share divided by the book value per share. So for this one, market price divided by book value per share. We first have to calculate book value. Book value is equal to common stock equity divided by the number of shares outstanding. Okay, so we already calculated that common stock equity, so we can calculate book value per share. We just take that common stock equity and we divide it by the number of shares of common stock outstanding, which is 100,000. I know that because it says there's 100,000 shares, and it's also a footnote on the balance sheet. So that's $12.93. So if we have the market price of $11.38, and we divide that by $12.93 to get the market to book, and I get 0.88. So that means that this stock is trading below its book value. So investors are not real excited about this company. They don't think it's going to do all that well. So we basically, their liquidity has increased. So that looks good. Inventory turnover is substantially lower than the industry, so maybe they're holding too much inventory, which goes hand in hand with their current ratio being too high. But then when you look at the quick ratio, it's right in line. Total asset turnover is a little low compared to the industry, but is improving. So they may not be using their assets as efficiently as they should. Debt ratio is very high, so they've borrowed a lot of money, which means that their times interest earned ratio is very low because now they don't have as much income to put towards that debt. Gross profit margin is on par with the industry and remains stable, meaning that they're controlling their cost of goods sold well and sales are strong, but their net profit margin is lower than the industry average and has been decreasing. So some of their expenses, probably related to the very high debt that they're carrying, is too high and making their profitability low. Return on total assets and ROE are both decreasing. So they're becoming less efficient and not using those assets and that shareholder money as efficiently as they should be. Price earnings ratio is much lower than industry and has declined in the past year, meaning that investors do not have a favorable outlook for this company. And their market to book ratio is below 1, so it means that they're trading below book value, which is always concerning.